The most important thing for you to understand in this whole video is that all these share classes are just different cost structures on the exact same investment. This is Kyle with Fundamentals of Finance, and today I'm going to do a deep dive on mutual fund share classes. Before I dive in, I'll answer two quick questions that I know are on your mind. First, why should you even care about this? Well, because the share class determines how much you pay to invest. And often you can get the same thing at multiple different prices, so your wallet will thank you for watching this video. And second, can't you just Google this? No, not really. If you could, I want to be making a video about it. I promise, if you try to Google it, you'll get a combination of incomplete and inaccurate information that will probably not give you the answers that you're looking for and leave you wanting to tear your hair out after about 30 minutes. How do I know? I just tried. So stick with me. I'll make it simple, tell you exactly what you need to know, and give you the inside baseball version from someone who used to work in the industry and knows these things in and out. Put simply, a share class basically determines the cost structure of a mutual fund. The reason this gets so challenging is because they are not that uniform from company to company. They don't all offer the same share classes, and sometimes they offer different share classes that mean the same thing. But don't worry, I'll simplify all that for you over the next few minutes. Let's take a look at the web page for the American Fund's American Mutual Fund, which I pretty much just picked since I know it has a lot of share classes. If you click this drop down, you can see all the options. The most important thing for you to understand in this whole video is that all these share classes are just different cost structures on the exact same investment. Think of it like shopping around for a TV. If you could get the same exact model of TV at Best Buy, Target, or Amazon for 3 different prices, you'd want to pay the lowest price, right? Often you'll have the same kind of options on mutual funds. To simplify the literally dozens of share classes out there, I'm gonna break down not just these, but all share classes from all fund families into 4 basic categories: retail, advisory, 529, and retirement. Each of them is used for a different purpose and accessible to different people at different times. So let's start with retail, which includes A, C, and no load share classes, which are F1 for American funds and often just have no share class listed after the fund name for other fund families, like you can see here with the T. Rowe Price Growth Stock Fund. The vast majority of share classes do not have a load, which just means commission, but a lot of them will be restricted for use by individual investors. We'll get to all those in a minute. But first, let's make sure you understand the difference between the 3 types of retail share classes, which are the ones you can easily access: A shares, C shares, and no load. In case you're wondering, yes, there used to be a 4th kind. They didn't just skip B, but as far as I know, you haven't been able to buy B shares for years, so I won't waste your time on them here. Let's start with A shares, since these are the oldest, most complicated, and least understood. Most A share investors pay an upfront fee, or load, to buy a mutual fund. These used to be over 8% back in the day, but now are more like 5 or 6% at the high end for stock funds, or 2 to 4% at the high end for bond funds. What I mean by the high end is that the commission you pay goes down as you invest more money with the fund family, meaning the total amount you've invested with American funds or Fidelity or whoever, not just in any one particular fund. As an example of how this works, here's the upfront fee schedule for the fund we looked at earlier, American Mutual Fund. You can see that the commission keeps going down as you keep investing and hit each breakpoint, and it gets to $0 once you have invested $1 million with the fund family. You can also usually get A shares without paying a load or commission if you're related to someone who works for the fund company, and you can get the next breakpoint a little early if you sign a statement of intention, which just basically means you plan to invest enough to get to the next breakpoint within the next 13 months. The downsides of A shares are obvious. It's the only one with an upfront commission, and it incentivizes you to stick with just one fund family. The second part doesn't have to be a bad thing, but it depends on the fund family you're investing with. I think American funds, MFS, and T. Rowe Price offer diversified suites of mostly strong fund options. But I wouldn't say that about most companies out there. There are 2 reasons why someone would want to buy A shares, even despite the downsides. If you're investing on your own, it's because they tend to have lower ongoing expenses than pretty much any other share class that individual investors can get access to. So over time, they're often the cheapest option, even after paying the commission. At least that used to be true. We'll get to that in a second when we talk about no load share classes. If you're investing through an advisor, good luck finding one who will let you buy A shares today. But if you can, they would almost always be the cheapest way to pay for advice. The upfront commission, along with a piece of the ongoing annual expenses called the 12B1 fee, which is usually around 25 basis points, goes to the financial advisor and are meant to pay for advice. I'll dive deeper into a comparison of the different ways to pay for advice when we get to advisory share classes. But before we get to that, I'll briefly introduce you to C shares. These have higher ongoing annual expenses and have no upfront sales charge. but they do have a 1% fee on the back end if you sell them in less than 1 year. To give you a sense of the fee difference, American Mutual Fund costs 58 basis points per year in A shares and 133 basis points per year in C shares, both of which are well below industry average. It may seem like it sucks to pay a one-time 3 or 4% charge up front, but trust me, when you're investing for decades, that extra 75 basis points per year can add up pretty quickly. The case for C shares used to be that it would allow you to be more flexible and invest with different fund families. But now with no-load share classes widely available, there's really no reason that anyone should ever buy C shares. In every scenario I can think of, there should be a better option. So that brings us to no-load share classes. For individual investors in something like an IRA or a regular non-retirement related brokerage account, no-load retail share classes are often the best option. They're better than A shares if you have less than $1 million to invest because they usually have almost the same ongoing cost but without any commission charges. For example, the F1 shares of American Mutual Fund have an expense ratio of 64 basis points per year compared to the A shares at 58 basis points per year. For other funds, this can sometimes be even closer or the same. If you do happen to have $1 million to invest, the A shares would still be better in this scenario since they're cheaper as long as you're okay with sticking with one fund family. For C shares, the old case about them freeing you from the upfront sales charge and allowing you to use funds for multiple fund families is totally dead because no-load funds now let you do that without any back-end sales charge and with much lower annual expenses. Don't buy C shares. To sum up the section on retail shares, no-load share classes have become much more widely available in the last 5 or 10 years, and they're almost always the best option for retail investors in IRAs or brokerage accounts. Now let's move on to advisory share classes, which in our American funds list here would be F2 and F3. This is where the most variety comes into play. Depending on the mutual fund company, they can be called I, which usually stands for institutional, ADV, which stands for advisor, or sometimes letters that mean nothing, like Z, Y, or N. The letter really doesn't matter. What matters is that you can only get access to these share classes through a financial advisor. They're cheaper on the surface because remember those roughly 25 basis points 12B1 fees that are embedded in the A share expense ratio to pay for advice? Well, they don't have those. So back to our American Mutual Fund example. The A shares cost 58 basis points and the F2 shares cost 37 basis points. So great. The advisory share class is 21 basis points per year cheaper than the A shares in this case. But unlike A shares in the advisory share class, the financial advisor will then tack on an additional annual fee for their advice of more like 1%, or often even higher if you have less than $1 million with them. That's why I said A shares are the cheapest way to pay for advice, if you can find an advisor who will put you in them. Because effectively, you're paying 21 basis points for advice in this case, instead of 1%. How much of a difference can that make? The short answer is a big one. And the longer you're invested, the bigger the difference will be. Here we have a hypothetical example comparing a $10,000 investment in A shares versus F2 shares with the 1% fee. For the A shares, we're showing the maximum upfront load of 5.75%. So you can see here, you start off with a $575 fee. Ugh, who wants to pay that? The A shares also have higher ongoing expenses. So you can see in the second column that your expenses, meaning the fees to the fund company, are also higher on the A shares. Not off to a strong start. The F2 shares have a 1% advisory fee. And when you total it all together, you can see that you actually pay over $2,500 more for the supposedly cheaper advisory share class due to the extra fee that the financial advisor is charging. And this is a very conservative example for the A shares, by the way. In reality, very few financial advisors will even work with clients that only have $10,000 to invest. And if they do, they're highly unlikely to charge a fee as low as 1%. So the advisor fees would likely be even higher. Also, if you had invested enough to hit one of the break points, you would have paid a lower upfront commission in the A shares than what I'm showing here. And if you'd invested for longer than 20 years, the cost gap would have been even higher. And most people invest for way more than 20 years of their life. The moral of the story is that while financial advice is very valuable and often worth the fees, it is not cheaper than buying A share mutual funds just because they'll give you a share class with slightly lower expenses. The last thing I'll mention is F3 shares. These are a subset of the advisory share class called clean shares, which have stripped out basically all the expenses except the management fee, which goes to the mutual fund company for managing the fund. American Mutual Fund's F3 shares only cost 27 basis points per year, which is not that much higher than a lot of index funds. And this is for active management. In practice, clean shares are very hard to come by though, and I promised you inside baseball. So here it is. Embedded in the expense ratio of most share classes, including most cheap advisory share classes, like F2 shares in this case, are some fees that mutual fund companies use to pay the brokerage firms that financial advisors work for, like Merrill Lynch or UBS. The mutual fund companies like American funds in this case don't keep these fees, So they'd much rather not charge them at all and give investors F3 shares. However, at the same time that most brokerage firms like UBS or Merrill Lynch are telling their financial advisors to push advisory share classes with the pitch that they are cheaper than A shares, they refuse to offer the even cheaper version because they want that money. The reality is that the fund company makes less on advisory shares, but over time, the client pays more, and the extra money goes to the brokerage firm. Financial advisors don't get to keep all the fees that their client pays to them. The company keeps a lot. So really, the push to advisory shares is just a way for financial advisors and the companies they work for to make more money. And who pays? You, the investor. The last two sections I'll cover, and these are the easy ones, are 529 and retirement share classes. 529 is especially easy. They're just like the other share classes we've already talked about, but with 529 attached in the name. 529A shares work just like A shares. 529C shares work just like C shares, and so forth and so on. These are used in 529 plans, which are a tax advantage way to save for college. In retirement plans, you'll never have access to more than one share class of the same fund. But for anyone curious, I'll briefly explain on how they work and why there are multiple options. You can see here that American Funds has 6 different retirement share classes, called R1 through R6. They may be called other things at other companies like K or I, but again, the letters don't matter and you won't have options. The vast majority of retirement plans use the cheapest share class for each mutual fund plan in the plan lineup. In this case, it's the R6 shares, which cost the same as the F3 shares that we discussed earlier, 27 basis points. However, for smaller companies, it can get pretty expensive to provide a 401k to their employees. They have to pay for someone to run the plan, and sometimes that cost is simply too much. So they just decide not to offer that benefit. In order to help with that, some mutual fund companies like American Funds created the more expensive retirement plan share classes with additional fees built in to help offset the employer's cost of setting up and running the retirement plan. It's more expensive for the investors, but when the alternative is not having access to a 401k at all, it's better to have it than not have it. So that'll do it for my comprehensive overview of mutual fund share classes. If you have any questions I didn't answer or have another topic you'd like me to dive into, leave a comment below and I'll get on it. In fact, this video came from someone doing just that, so thank you. And if you want to learn the 9 habits you need to be a successful investor, check out the link below in the description. Thank you for watching, and I will see you in the next video.